How's it going, guys? My name is JSE and welcome back to Met Eish. Today we're going to be looking at a Facebook Easy Equities Group darling, PPC Cement. We're going to be having a look at a brief history of the company. We're going to look at what it's done financially in the past couple of years. I've spent the last 3 days going through all of the financial information from 2014. It's been long, and we're going to have a look, a very estimate look at what I think the share price will be going forward into the next 10 years. We're going to look at an estimate price for 2030. But before we get started, this video is sponsored by Blank Cups. Blank Cups. Put your logo on my cup. For more information about Blank Cups, email us at moneymeteish@gmail.com. Before we get started, this is just a disclaimer, again, that I am not a financial advisor. This is not financial advice. Today we don't have the spec boom, it got too big for the desk, and the new one we're trying to grow is too small. So this is not financial advice. All of the numbers, all of the information that I used in all the calculations comes straight from PPC's website, all of their financial information. So I'm not just sucking these numbers out of the air. These are numbers that PPC has published themselves. So we're going to take that and then we are going to forecast using averages of all those numbers to get what we think the share will be worth in the future. So this video is in no way intended to be a guide on whether or not you should buy this share. This is just what I think it will be worth. It's not financial advice. Okay? So now that that's covered, let's get started. Like I said earlier, this took me a really long time to put together. I really had a lot of fun, but I would really appreciate it if you just hit the like button and subscribe to the channel so that I could know if these are the kind of videos that you like, and maybe have a look at other companies. I said on Instagram that I would look at Brickor as well. So if this video gets enough likes, then I'll do that one relatively soon as well. So let's look at PPC Cement. PPC Cement was founded way back in 1892 and it listed on the JSE in 1910. Depending on if you count SAB or not, which I personally don't think you should, PPC is the second longest listed company on the JSE after DRD Gold. PPC operates in 6 African countries, and those are South Africa, Botswana, Zimbabwe, Rwanda, the DRC, and Ethiopia. In my opinion, Rwanda is really the jewel in the PPC crown. It was one of the only projects to be completed below budget, and it is a massive generator of growth for the company, where its South Africa operations and its Zimbabwe operations are seemingly becoming more and more of a fiscal drain on the company overall. PPC sells 6, soon to be 5, product categories, all of them having to do with cement or concrete or ready-mix in some sort of capacity. PPC recently concluded a deal to sell PPC lime, not the fruit, for R500 million. So that deal should be concluded by the end of 2021, which I think is a good thing since lime was not a huge revenue driver for them and it's really just been losing money for ever, basically. So for them to step away and sell a non-core asset will allow them to generate some money to pay down their massive debt. So let's have a look at how PPC, the company, and the share has performed recently. The PPC share price is up 380% if you look at the last year. But it's actually down 90% off its all-time highs, which was in 2007. And the share hasn't traded above 10 Rand since Nenegate in 2015, when former President Jacob Zuma spent a little bit too much time listening to Brenda Fassie and decided he wanted his own weekend special. So what's happened since then? PPC has had 4 CEOs since 2014, and the man currently in charge of righting this ship is 48-year-old Harvard alum Roland van Wijnen, with the Dutch national having 17 years experience with another multinational cement conglomerate and PPC competitor LafargeHolcim. Roland van Wijnen has been the CEO of PPC since late 2019, and his whole reign has basically just been COVID. The lockdowns happened within 6 months of him taking over, so it would be really difficult and kind of unfair to judge him based on what we've seen, since the company, along with every other company, has had to put up with everything they've had to put up with. But the company wasn't in a great shape before lockdown happened to begin with. The PPC share price hit its all-time high in 2007 during the build-up to the 2010 FIFA World Cup, when South Africa was construction crazy and everybody was building everything, be that stadia or guest houses or the highways or any of those things. We were building crazy, and PPC was benefiting from that to a great extent. But since the 2010 World Cup, the construction industry in South Africa is on its knees. PPC is one of a number of companies in this sector that are over 100 years old and facing a serious existential crisis. After the 2010 World Cup, the board decided that the South African economy was not going to give it the growth it needed, and so it looked into Africa. And personally, I think that that has been a great, if not extremely expensive, decision. The board said in 2014 that Africa would make up 40% of total group revenue by 2017. But the majority of the factories that they were building in Africa weren't even online yet in 2017. However, like I said before, Rwanda has been an absolute gem. It's the only project that was completed under budget, saving the company $5 million US, since all construction in Africa is done in dollars, not rands, which means PPC is also very susceptible to fluctuations in Forex. And in 2017, they took on massive Forex losses of over 100 million Rand. The 2017 financial year was an extremely difficult year for PPC, with the before-mentioned Forex losses. They also had an 85% increase in tax in Zimbabwe. They had to make out payments for their BEE scheme, which is roughly 30% of the company's debt holding, and they had a downgrade on their bonds by S&P, meaning that the company's earnings per share, how much money they make for every one share the company has, fell from 117 cents to 8 cents, or a 93% drop in earnings per share, which is an enormous amount of money that the company just didn't have anymore. It was recently announced in its SENS announcements that PPC has reached an agreement to sell its long-struggling lime business, not the fruit, for $500 million, which is great news, but I personally think will do little to lighten the debt load, since it's only $500 million and this company has over 5 billion rands worth of debt. I think much better news is the finalization of the restructuring of its $175 million US debt in the DRC, which equates to about 2.4 billion rands worth of debt, which they can now remove from their liabilities and it will give much more freedom going forward. PPC has been urging investors to exercise caution when dealing with PPC shares until the debt restructuring process was complete. And now that that process has been finalized, they have removed that cautionary advisory. It should mean that people have much more confidence in what the company is going to be doing going forward. And that's a promising sign. So let's have a look at some challenges facing PPC Cement. The company itself actually regards its ridiculous debt burden to not be one of its biggest threats, but instead they consider the dumping of inferior products from Asia into the South African market as a much bigger threat. And the company has recently been discussing with government in order to have cement classified as a designated product, which basically means that only locally produced cement and concrete and ready-mix will be able to be used in government contracted projects like roads and housing projects that the government commissions and all those other government spending projects on infrastructure, which PPC is hoping the government is going to be doing a lot more of now in the wake of COVID. But government spending only makes up about 2/3 of the company's revenue, and a large portion of the remaining 1/3 actually comes from people building at home. PPC's revenue historically has been quite heavily tied to remittance, which is people working in one place and sending money to family members in another. So if people are working in Johannesburg and sending money back home to Venda or to the Eastern Cape or the Northwest or anywhere else in the country, that actually has quite a big tie to how much money PPC makes, obviously because people are building at home. So that actually was surprising. It makes sense when you think about it and you say it out loud. It makes total sense. But when I read it the first time, I was shocked, and I feel a little bit stupid for being surprised at that. So, the company has been facing the prospects of a rights issue since late 2020, when it promised its debt holders that it would have a rights issue in early 2021. That date was pushed back from April to June, and now has been pushed back again to September, which is a good sign. It means that the debt holders think PPC has the ability to reduce its debt load to a point that they are happy with. So if PPC can continue to reach those debt targets, it won't need to have the rights issue, which is a good thing for all current shareholders. Because if the company has to have a rights issue, they will issue more stock, meaning that the percentage of the company that one of your shares is worth is now smaller. So them being able to fight off this rights issue is a good sign. So if we look at what an estimated future share price could be, big, massive disclaimer in the beginning, I do not have a crystal ball. I obviously cannot tell the future. I have no idea what the future holds. Past results are also no guarantee of future results, but past information is all I have. So what I did is I took the revenue and EBITDA information dating back from 2014 and I averaged it all out to get average numbers that I am going to be working with to have an idea of where this share price could be in 10 years' time. Obviously 10 years is a ridiculously long amount of time and no one can tell the future, but let's try and see. If you're watching this in 2031 and I was massively wrong and PPC shot to the moon, let me know. But I guess we'll have to wait for that. Anyway, I took the average revenue information and EBITDA information from 2014 to 2020 that PPC has published on their website. And PPC over that period has averaged a revenue growth of 1.9%, which is nothing. And they have an EBITDA growth of -6%. So the future assuming everything stays the same, is looking rough. If we account for the sale of PPC Lime and the restructuring of the debt in the DRC, and assuming the rights issue doesn't happen, right, using all the average numbers, I come up with a future enterprise value of 41 billion rand for PPC. And if we divide that by the number of shares that are still outstanding, which is a serious guess because their shares that are available, it's like a yo-yo, it's up and down. So I just took the 2020 numbers, I didn't average it out, I just took the 2020 number for that. Assuming there's no rights issue in the next 10 years, I come up with a share price per share of 4 Rand 90, which is only a 32% gain from the share price today, which is Sunday, the 23rd of May, 2021. So realistically, that is not great. Over 10 years, you would really be hoping to at least double your money. And here you're only getting like a 1/3 growth. If you had just invested in a broad market tracking ETF, like the JSE Top 40 or the S&P 500, you are almost guaranteed, not really, but historically, to double your money over 10 years. So you would have done better just putting your money in the S&P 500 over this 10-year period. So would I personally, Mr. Met Eish, buy these shares in PPC? No. I personally like companies that I can buy and hold forever, that pay me for owning them. And PPC hasn't paid a dividend in 5 or 6 years, and it doesn't look like that's going to change anytime soon. Generally, I'm okay if a company doesn't pay a dividend, but those are companies that have huge amounts of growth, and we've seen that PPC's average growth is 1.9% a year, so there's no growth there either. In conclusion, if you want to put money in the market and have it grow over a long period of time, you are better off buying your average index fund. But if you have 1,000 Rand to spend and you want to take a punt on PPC, you want to just gamble on this company in the short term, go ahead. Once again, not financial advice, just my opinion. So yeah, take it from where it comes. Not a financial advisor over here. If you do require financial advice, speak to a registered financial service provider. But just a quick fun fact to close off, if you had invested in PPC in August of 2000 and you held on diamond handing that investment till today, you would have gained a staggering, mind-blowing 0% capital gains. The share price is almost exactly the same as it was 21 years ago in 2000. So if you want to take a bet on the company in the short term, thinking the government is going to have an infrastructure spend and boost the revenue of PPC, then it could be a short-term hold, but this does not seem, in my opinion, to be a company to hold for the future. You are much better off just putting your money in an index fund. Thanks for watching, guys. I hope you enjoyed the video. A lot of effort and research went into putting this together, so I would really appreciate it if you hit the like button and subscribe to the channel. You can also follow Money Met Eish on Instagram and Facebook and Reddit and all the Money Met Eishes everywhere. So yeah, if you want to see more videos like this, please comment down below with the company you would like me to have a look at next. Thank you for watching and good night.